Well, good morning. Thank you for having me. The name of my company is American Healthcare REIT, and we are a diversified healthcare REIT focusing on clinical healthcare real estate. Clinical means where patients are being seen by providers. The main types of assets we buy are outpatient medical buildings, assisted living, independent living, skilled nursing, those types of properties. We've been around a long time under different names, but in essence, American Healthcare REIT was formed in the fall of 2021 by merging two non-traded REITs along with our management platform. We combined those three companies in October of 2021 and formed American Healthcare REIT. And as I'm sure you're aware, we raised additional equity and became publicly traded a little over a year ago in February of 2024. Okay, so our firm has always been a REIT since day one. So these companies were launched in a series of non-traded REITs, really going back to 2006, although the two that were combined to form AHR were formed in 2013 and 2016. I've been in the REIT business since 1992. I fell into it by chance. I worked for a publicly traded REIT in Denver called American Health Properties. That's my hometown. The day I started there, I didn't know what a REIT was. They were not that common in the early 90s. I had to ask around. I had to ask a lot of people before I started because you didn't have Google back then. You couldn't just look it up. And I really like the concept, right? It's basically a mutual fund for real estate. You get the benefits of owning institutional quality real estate, which most people can't do, right? You need a lot of money to invest in a diversified portfolio of institutional real estate, and $100 million or more. But this allows the regular investor to buy publicly traded shares, and you get the diversification, and you get all the tax benefits, right? I mean, just like when you own real estate, you get to you take depreciation against your taxes. It really works the same way with a REIT. When you get your distribution, every monthly or quarterly, however it's paid, at the end of the year, you'll get a summary, and typically a portion of that distribution is tax deferred, mostly due to the real estate depreciation within the REIT. So, it's a great way to invest in big time real estate on a smaller scale and get that diversification. So I love the concept. I didn't know anything about healthcare back in 1992, but I'm so fortunate that I fell into this business by chance. Healthcare is the biggest segment of our economy. It's pushing 20% of our GDP. It's growing rapidly. When I started out, it was 12%. So, to go from 12% to 20% in 30 years is a lot. I mean, and that's how an economy that's grown substantially during those 30 years. And it's really driven by demographics. We've got a growing and aging population in this country, and that's going to continue, right? The baby boomers are just pushing 80, right? They start turning 80 next year. So you're going to have a 15-year period of extremely rapid growth in the over 80 cohort in this country, and that's really who occupies our assisted living and skilled nursing facilities, which is the majority of our asset base. So, Great Recession, 2008, 2009. We were working on our first non-traded REIT back then. We had zero impact from the Great Recession. We were mainly outpatient medical and assisted living, and those businesses held up just fine because they're need-based. They're not driven by the overall ups and downs of the economy. So very fortunate. I love the REIT space, and I think we're very lucky to be in healthcare. So it's a demographic story, as I mentioned. When I got involved in the 90s, they were talking about the baby boomers pushing 55. And, there's going to be so much demand for healthcare real estate. People are getting older, which was true. But, over time, that has just become more and more of a factor in the growth of healthcare, because as we age, the growth in spending is almost exponential. We spend many, many more times on an 80-year-old than we do on a 60-year-old in this country. And if you look at the fastest growing age brackets in this country, it's 60s, 70s, 80s, 90s, and 100s, at least in percentage terms. And we know that's in place, right? The demographics are very predictable. You know exactly how many people are in the country and how old they are, and what to expect going forward as far as what their age is going to be on average. And with that comes growing demand for healthcare, which means you need more healthcare real estate. So I think that is probably the number one thing about healthcare real estate. And everyone, I think, agrees with that. I've never met anyone who said, well, I think we're going to spend less on healthcare in 5 years than we do today. And we can debate how we're going to pay for healthcare, and different people have different opinions. But I think everyone realizes that the demand for healthcare is going up. And as the years go by, it's going to get higher and higher, at least for the next 15 to 20 years. I think that's a pretty safe bet. I think the biggest headwinds are that a substantial portion of our healthcare spending is government paid, right? If you take Medicare, Medicaid, and the V8, that's the VA, excuse me, not V8. That is, more than 50% of our healthcare spending, and that concerns some people, right? Because you have what's called, stroke of the pen risk, perhaps. And we've seen times in past years where, Medicare and Medicaid is looking to save money. We're going through that right now, right? Of course, with the upcoming, budget negotiations. So I think some people are worried about that. I get it. I've been around, like I said, for over 3 decades, and I've seen periods of time where, the government does try to cut back its healthcare spending. And, the industry oftentimes those cuts get reversed because, you can only, skilled nursing, for example, there's a limit to how much you can cut. It's a very low margin business. And a small cut in skilled nursing reimbursements, whether it's Medicare, Medicaid, or both, can literally put operators out of business. And we saw that in the late 90s and early 2000s. So I think that is probably the number one question we get is, what about risk to Medicare and Medicaid? Now, the majority of our portfolio is private pay, a lot of assisted living, which is private pay, much like an apartment. The big difference is it's need-based, right? Nobody wants to be in assisted living. People move into assisted living because they need help with some aspect of everyday life, whether it's bathing, feeding, dressing, medications, etc. But they're really not able to be on their own. People who can be on their own are generally not going to want to be in assisted living. But the average move-in age to assisted living is in the early 80s, and you can see going forward for the next 15 years, that is where a substantial portion of our population growth is going to be. I think if you look at our metrics, and there are about 16, 17 publicly traded healthcare REITs, very different. Some are very, very big. Some are very, very small. We kind of fall in the middle there. We have a diversified strategy. We don't just focus on one asset class. Some REITs do. Other REITs are diversified. I think the biggest benefits that I think we have to offer are, from a size perspective, we're in a great spot. We are large enough to be diversified. We've got about $5 billion in assets. But small enough to where we can do, smaller acquisitions, and they have a substantial positive impact on our company. We don't need to do billion-dollar deals in order to grow our REIT and our earnings. We can do smaller transactions, 20, 50, $100 million, and they have a significant positive impact on us. So it makes it easier for us to grow, not just in size, but in earnings as well. I love the diversified strategy. I think there are a lot of benefits to it for several reasons. Number one, from an acquisitions perspective, it gives you a wider range of assets to look at. So we don't have fixed percentages that we want to be. We look at what are the best risk-adjusted returns available to us today, and that is the direction we go. So prior REITs, we actually had hospitals years ago in some of our prior REITs. We haven't done a hospital in 15 years. To us, the risk-adjusted return just isn't worthwhile on hospitals and hasn't been for a long time. But, for the last, early on, outpatient medical was the best risk-adjusted return, and that's what we focused on. And during COVID, it was by far the best asset class. So when COVID hit in 2020, our long-term care buildings, our assisted living and skilled nursing facilities took a hit during COVID, as you can imagine, because people couldn't move in. Outpatient medical did great. We actually grew our occupancy in 2020 during the height of COVID. From an acquisitions perspective, from a management perspective, you're able to focus on assets that give you the best risk-adjusted return opportunities at that point in time. Today, we are mostly buying managed assisted living, senior housing, so assisted living and independent living. In our minds, managed, because there's so much growth in the space, bottom line earnings are growing at a rapid pace. So a management structure versus a lease structure allows us to benefit from that growth as opposed to our tenant. And senior housing, if you look at the demand drivers there, it's that over 80 cohort that I mentioned, and that number is just growing very rapidly. And there's been very little new supply coming out of the ground over the last 6 years. So the industry is going through the best period of time I've seen in my entire 33-year career. So that's what we're focusing on right now from a growth perspective. If you look at our acquisition strategy over the last few years, it's been mostly managed senior housing. And we've actually been, reducing our exposure to outpatient medical. We've been selling select assets over the last 2-3 years, assets that are smaller, maybe more rural, off campus, that really don't fit into our long-term strategy. So because we don't focus on just a single asset class, we're able to zig and zag based on where the best opportunities are at that point in time. Now, it's still going to be healthcare. It's still going to be clinical healthcare. but not necessarily just one or two asset classes like a lot of the REITs do.